Why debt can destroy a great company. Sometimes the biggest risk isn't the business, it's the balance sheet. Imagine two companies. Both generate $1 billion in revenue. Both are growing, both have strong products. Both appear profitable. But one has almost no debt. The other owes $5 billion. From the outside, they may look similar, but financially, they could be completely different businesses. And this is where many investors make one of their biggest mistakes. They look at the story, but ignore the balance sheet. Let's say a company earns $300 million per year from its operations. Sounds healthy. But now imagine it has billions of dollars of debt, and every year it has to pay $250 million just in interest. Suddenly, almost all of that operating profit is gone. The company may still be growing. Revenue may still be increasing. Customers may still love the product, but the lenders are taking most of the cash. And debt becomes even more dangerous when interest rates rise. Here's why. Companies don't always repay their entire debt when it matures. Very often, they refinance it. Imagine a company borrowed money years ago at 3%. Now that debt matures, but new financing costs 7%. The business hasn't changed. The factories haven't changed. The customers haven't disappeared. But suddenly the cost of maintaining the debt has more than doubled. That can completely change the economics of the company. And this is why investors should pay attention to something called the debt maturity schedule. Because sometimes the problem isn't how much debt a company has today. The problem is when that debt needs to be refinanced. There's another number worth understanding: interest coverage. Very simply, it asks, how easily can the company's operating profits cover its interest payments? If a company generates $1 billion in operating income and pays $100 million in interest, the situation may be manageable. But if it generates $300 million and pays $250 million in interest, there isn't much room for error. One bad year, one recession, one lost customer, one unexpected expense, and suddenly the balance sheet becomes the story. Then comes the next problem: cash flow. A company can report accounting profits while still struggling to generate actual cash. And debt doesn't care about adjusted earnings. Debt requires real money. Interest payments must be made. Bonds eventually mature. Banks eventually want their money back. So when analyzing debt, free cash flow can be far more revealing than simply looking at net income. And if the company cannot generate enough cash, it has only a few options: sell assets, cut investment, issue more shares, borrow even more money, or in extreme situations, restructure its debt. Notice what all of those options have in common. They can hurt shareholders. That's why a great company can still become a terrible investment if the capital structure is wrong. So when you look at a company, don't just ask, is this a great business? Ask, how much debt does it have? How expensive is that debt? When does it mature? How much interest is being paid? How much free cash flow does the company generate? And most importantly, what happens if something goes wrong? Because strong balance sheets give companies time. Weak balance sheets take time away. And in investing, survival matters a lot. The next time you find an exciting company with incredible growth, before looking at the stock chart, look at the debt. You may discover that the most important risk was hiding in plain sight. This content is for educational purposes only and is not financial advice.